Good afternoon, and thank you for joining the web conference regarding Department of Market Monitoring 2021 First Quarter Market Issues and Performance Report. Calls and webinars are recorded for stakeholder convenience, allowing those who are unable to attend to listen to the recordings after the meeting. The recordings will be publicly available on the ISO webpage for a limited time following the meetings. The recordings and any related transcriptions should not be reprinted without the ISO's permission. To submit a question, select All Panelists from the drop-down menu in the chat panel, then enter your question in the message box provided and send. Alternatively, at our Q&A session, you may also press #2 on your telephone keypad to enter the question queue. You will hear a notification when your line is unmuted, and at that time you can state your question. If you require technical assistance, please send a chat to the event producer. With that, I will turn the webinar over to Amelia Blanke. Amelia, please go ahead.
Thank you. Thank you, Michelle, and thank you, everybody, for being here today. This is a presentation of our Q1 report for the year 2021, covering January, February, and March of this year. It represents the very hard work of a department full of people, and as always, it's my pleasure to present their work to you. And it is, I give them the credit for everything that's right, and I'll take the blame for everything that, all of the typos that may remain. One of my favorite parts of doing this presentation and the value of doing these presentations is really taking questions. So please do ask questions, feel free to ask questions in the chat, and feel free to press #2 and enter the queue. I will stop during the presentation to take questions as well. There is a link to the report in its entirety at the bottom of the screen here, and it can be found on our website. With that, I will get started. Q1 of 2021, we had a week in February over the President's Day weekend that featured cold weather in the Midwest and in Texas. That led to high prices, both for electricity and gas over that week, as well as generally higher prices in Q1 of 2021, not only due to that short period in February, but also due to overall lower hydroelectric generation, as well as an increase in generation outages, which we saw as well. In the Q1, there's been a continuation of a pattern that began in Q4, again, of lower 5-minute prices that are persistently lower than both the 15-minute and day-ahead prices. That appears to be correlated with the increase in imbalance conformance adjustments. Those were previously known as load bias, which continue to increase in the 15-minute market rather than in the 5. And finally, settlement timeline changes, which were implemented by the ISO effective January 1st of this year, have delayed reporting on areas for which we rely on final settlement data. And for this reason, this report does not cover the same, all of the same areas that we traditionally do report on. And quite a few highlights for the EIM in this report. First, Turlock Irrigation District and the balancing area of Northern California joined the EIM on March 25th. That is the portion of the balancing area of Northern California that was not already entered into the EIM in the form of SMUD. And with them brought about 6 gigawatts of generation and over 3 gigawatts of transfer capacity. And since that time, we have seen the entry of Public Service of New Mexico as well as Los Angeles Department of Water and Power. And as of today, we have a new EIM participating entity, Northwestern. It's very exciting. And finally, sufficiency test failures. Both of two tests that we focus on in particular, the big range capacity test and the flex ramp sufficiency test. Failure in both, the consequence of failure of both of these tests has been undersupply power balance constraint relaxation, which drove up average prices, particularly for Arizona Public Service and the Energy and the Salt River Project, and peak net load hours. And overall, in the EIM, we continue to see that prices in the Northwest are regularly lower than the rest of the system due to limited transfer capacity, and that prices on average in Bank and the ISO, the California areas, exceed the rest of the system. That tends to be due to both the greenhouse gas cap and trade price difference as well as due to congestion. But in February, we saw prices in the southwestern areas, which averaged over $60 a megawatt hour, exceeding the rest of the system, including California. Finally, this report covers, as the special issues section, the implementation of two new initiatives, Commitment Costs and Default Energy Bids Enhancements Phase 1. This first phase allows scheduling coordinators to request reference level adjustments and apply for aftermarket cost recovery. And this was implemented by the ISO in February in the midst of this gas price spike, as partially as a way of allowing market participants to reflect their marginal costs in their reference values. Ferc Order 831, Phase 1, compliance, which allowed bidding between $1,000 and $2,000 $2,000 a megawatt hour for a subset of resources, and also set the power balance constraint violation penalty price to $2,000 per megawatt hour. And this has been a very busy week for the ISO. This week, we've seen the implementation of several new additional things. In addition to the new NWE joining, Northwestern joining the EIM, we've also seen the implementation of Ferc Order H1 Compliance Phase 2, which we will talk about in the Q2 report. There is some helpful information at the end of the report that does outline some of the parameters for bidding under Phase 2, which may be help to you. I'll start out here with our average monthly market prices. As traditionally, the blue line represents average monthly day-ahead price. Yellow is average 15-minute price, and the green is the average 5-minute price. We've extended this back to 2019 in part to highlight a comparison with Q1 of 2019. Our average prices were higher than Q1 of 2020 at $44 per megawatt hour for day ahead, $43 for the FMM, and $37 for the RTD. A couple of things I'd like to point out on this chart. The first is that we're seeing this convergence on a monthly average basis consistently in the Q1 between the day-ahead and 15-minute market. The other thing I'll point out is that, to go back to 2019, there was a spike in natural gas prices also in February of 2019, just as we saw in 2021. However, the natural gas prices in February of 2019 were lower than the prices that we saw in 2021. This chart shows exactly that. These are our average monthly natural gas prices at a hub level, going back to 2019 for Henry Hub as a sort of a national benchmark, as well as PG&E, Citygate, SoCal Citygate, Kern, and then to reflect some of the conditions in the EIM Northwest Sumas, as well as the El Paso Permian in the Southwest. As you can see here, and I'm not sure if you can see my cursor or not, the average prices in February were very, very high, highest at SoCal Citygate on a monthly average basis, but also high in the Desert Southwest, El Paso Permian, as well as Kern. And we did see an increase in PG&E as well. When we take a look at the daily prices, it just highlights the short duration of these extremely high prices. Unlike the 2019 period, this wasn't a longer duration of a more moderate increase in prices. This was about a week of an extended high price period. This is showing on a daily basis the hub prices for the same set of hubs, and you can see here the spike at El Paso Permian for the Desert Southwest as well as SoCal Citygate. This period happened to extend over the President's Day weekend, which explains the number of days with the same very high prices, because that was covering the costs on Saturday, Sunday, as well as Monday. On the right-hand panel, you can see our average prices. These are average ISO load-weighted prices in the ISO for day-ahead, 15-minute, and 5-minute market over the same period. And you can see the high correlation between our high gas prices and high electricity prices. The ISO is holding a market issues and market performance and planning forum, MPPF, next week. The last one was held on March 4th and included a lot of interesting metrics on this period, given that it occurred right afterwards. So if you're interested in more detail on this particular week in the market, I would suggest that you consult the link on pages 6 to 24, which I've included on the slides here. With that, I'll move on. Our non-hydro renewable production increased in the ISO by about 15%, while hydroelectric production decreased 25%, and that's a comparison of Q1 2021 to Q1 of 2020. Although as measured on April 1st, the snowpack in 2021 was higher than in 2020. What we've seen looking at the measurements following that period is that our snowpack is now lower than it was in 2020 at the same time. And we're also seeing, as in other areas of the West, very dry conditions across the West. Overall, renewable generation increased by 6%, and that's really due to the increase in the amount of capacity online for our solar and wind resources. This has also been reported in a board memo, and apologies for the background noise, tree dogs and two teenagers. And a board memo which we presented to the board, there's been an increase in what tends to be called renewable curtailment, or downward dispatch of renewable resources. As we've seen, actually going back to 2016, 2017, almost all of that renewable curtailment has been due to economic downward dispatch, shown here in dark blue. As the renewable fleet has grown, so has our renewable curtailment. One other feature that we've been tracking is the availability of imports. CAISO's markets tend to rely on imports to about 30% of generation on an annual basis. What we can see here, and obviously there's a quarterly variation, this chart compares average hourly interchange by various measures on a quarterly basis, comparing 2021 quarter one on the far right to 2020 Q1 right in the panel right next to it, and doing the same thing for the other three quarters. As you can tell looking at the chart, there's a very seasonal pattern. We tend to see our highest renewable generation in Q2, and that is tied to especially a lot of exports through the energy imbalance market, shown as the difference between the black dotted line and the gray line across the peak of the solar generation hours. That occurred in Q1 of 2021 as well. One other feature I'll note here is that we're showing our average exports in light blue in the day-ahead market and a lighter yellow in the 15-minute market. There was a slight increase here in Q1 in exports, but nothing compared to our 2020 Q3 export values. Let's go the wrong way. There we go. One of the other things that we've noticed is a change in resource adequacy import bidding behavior. This is due to a change in the resource adequacy bidding requirements that came from a California Public Utility Commission ruling that began to apply at the beginning of this year. That ruling required resource adequacy imports to bid in at or below $0 per megawatt hour. And so what we've seen in January, February, and March here is an increase in the portion of resource adequacy imports that are bid in at those very low dollar values. As a reminder, I'm sure some of you are going to ask why we're seeing any bidding at all from resource adequacy imports above that value. Some of our resource adequacy is non-CPUC jurisdictional. So for those entities, those load-serving entities, this regulation would not apply. The other thing I'll note on this chart, and something that we're continuing to monitor is a decrease in the bidding volume of imports coming into this year. Really lower if you compare Q1 of 2021 to 2020, 2019, 2018, or 2017. It's a fairly dramatic decrease. And I will cover this and then stop for questions for a second. One of the other factors that we saw in the first quarter of 2021 was an increase in outages. This is not an increase compared to Q4, as you can tell from the chart, but it is an increase over any of the Q1 values that we have seen in previous years. Comparing on a fuel type basis, there was actually a decrease in outages from gas generation, but what we did see was an increase in outages from other fuel types, particularly hydro. Go to Q1, so I think that is consistent with the change in hydroelectric availability this quarter, and looking forward to the rest of the year. Okay. Good time to stop for questions. I cannot see the chat, so if there are any questions in the chat, Jennifer, would you let me know?
I don't see anything there yet.
All right. Moving on. Thank you. Our CAISO market was structurally competitive in all hours of Q1 2021. So although we saw an increase in prices and, in fact, saw very high prices over the President's Day weekend and a few days following, in February, all of those hours were structurally competitive. What we're showing here are values of the residual supply index. That index is created by taking a measure of demand, which includes ancillary services, in our day-ahead market by hour, and taking the ratio of that to supply. That supply includes, is limited by import constraints, for example, several other factors, and then removing either the top one, the first largest pivotal supplier, or the two largest, or the three largest pivotal suppliers. In all cases, the ratio of supply to demand with 1, 2, or 3 removed is greater than 1. This is our average. This is our chart of our average hourly prices in the ISO market for the first quarter. The red dashed line is showing our net load. That is our load or demand minus our utility scale wind and solar. As we've seen an increase in behind-the-meter solar, we have seen our load, average load, showing some of the same pattern that you see here for the net load, with very low loads relatively during periods of high solar generation in the middle of the day. So the net load reflects both the behind-the-meter and the utility scale. So what we find is that our average prices, shown in blue, yellow, and green here, reflect that net load shape. One of the changes between this chart and the same chart that we produce quarter after quarter, between this quarter and the last, is the convergence really between the yellow 15-minute market and the blue day-ahead, and the persistently lower 5-minute market prices, particularly in these peak hours of the day. One of the factors that we think may help to explain that is a difference between the imbalance conformance, previously known as load bias, in the 15-minute and hour-ahead market compared to the 5-minute market. This chart shows the average hourly imbalance for Q1 of 2021 in solid lines for the hour-ahead 15-minute and 5-minute market, which is in blue, and for the Q1 of 2020 in the dashed lines, dotted lines. You see here there was an increase during peak hours across the peak net load hours of the day, where although the 5-minute RTD did increase slightly in the earlier morning hours, those have stayed well below the 15-minute market values. Just to highlight, we've seen a change recently as the solar fleet has changed and what's the coming of daylight savings time, I think. We've seen a very big change in the regular pattern of load biasing and much lower values in Q2 for this recently in Q2 in the first morning net load peak. One of the other features of our real-time market, which we don't have in the day-ahead market, is the flexible ramping product. A minimum area requirement for the flexible ramping product, which I realized I forgot to write flexible ramping product on the screen, was introduced in November of 2020. That minimum area requirement was introduced in the 15-minute market, but not in the 5-minute market. Since its introduction, we have seen it binding quite frequently in the CAISO. That's shown in the left panel. And you can see here that it's depending on the month, but typically binding in about 90% of intervals in the downward ramping direction and over 90% on average in the upward ramping direction. The minimum area requirement can bind in other areas, but typically does not. In the upward ramping direction, there were no instances of minimum area requirements in other areas in 2021 in the upward direction. And in the downward direction, we have seen these binding for PAC East as well as for PowerX, but in under 5% of intervals. This chart shows the monthly frequency of positive system or ISO flexible ramping shadow prices. What you can see is that starting with the implementation of that minimum area requirement, there has been a higher frequency of non-zero prices. Typically, prices for the flexible ramping product have been zero, and they continue to be zero in the 5-minute market, where we continue without this minimum area requirement to see a significant amount of procurement in the areas that are disconnected from the rest of the system by transmission constraints. And I have been told there's a question in the chat, which I can't see, but I'm stopping for it. And thank you, Jennifer.
Does the enforcement of the minimum area requirement in the FMM 15-minute market, but not the RTD, have an impact on price divergence in the CAISO BAA?
I think that's exactly what you can see here for flexible ramping product prices. To the degree that a higher FRP product price decreases, that can also lead to sort of higher opportunity cost for energy as well. So yes, this is another factor that may explain some of the difference in prices between the FMM and the RTD, the 15-minute and the 5-minute market. Yeah, thanks Dan Williams of CES for that question. I'm just going to catch my train of thought here. One of the other factors, that's not where it is. One of the other factors that we see potentially leading to that convergence between the day-ahead and 15-minute market is the arbitrage that is created by convergence bidding. The virtual bids in our market, both virtual demand and virtual supply, are settled on the difference between the day-ahead and the 15-minute market. So a factor like FRP, opportunity cost, or the difference in biasing is not offset in any way. There's no availability to financially arbitrage between the 5-minute market and either of those other two markets and converge those prices. So that's the other reason. We saw an increase overall in average monthly day-ahead ancillary service requirements, an increase over Q1 of 2020. We continue to see higher spin and non-spin. These are set by either the single largest contingency or essentially 3% of load and 3% of generation. We've also seen an increase in regulation requirements. Back when I was a young analyst, these were typically 300, between 300 and 400 megawatts, but typically closer to 300. And what we've seen with the greater rates of renewable generation on a utility scale is an increase overall in those regulation requirements. That continues to be the case in the first quarter of 2021. This is one of the few settlement-based charts that you'll see in this presentation. Our estimate, and this is, number of caveats here, this is our initial first estimate of costs, is that they have increased to about $44 million from $30 million in the same quarter of 2020. That's due both to the higher opportunity cost of energy, so we saw higher costs overall, along with higher marginal costs of production due to the higher gas costs, as well as higher ancillary service requirements. Congestion increased in the first quarter. This is compared to Q1 of 2020, with $194 million of estimated day-ahead congestion rent, which is greater than the first quarter of 2020, which was $75 million. So obviously, not anything like our third quarter, but we do see the same overall pattern in Q1, which is a decrease, and I realize I may have forgotten to change the font size, decrease of prices in PG&E, and an increase in Southern California Edison and San Diego Gas and Electric. I will stop here for any additional questions, if there are any. Tree Lake Irrigation District and the remainder of Bank, non-SMUD portions of Bank joined the EIM on March 25th. This is a map I downloaded from the ISO yesterday, and so it shows, in addition, as current active participants, both Northwestern Energy, who joined as of very early this morning, as well as the other two entities that have joined with us this morning. Public Service of New Mexico and the Los Angeles Department of Water and Power. As the EIM expands, the transfer capacity available between areas expands as does the participating generator capacity. There was a change in the pricing pattern in EIM that I think is worth noting in February. February, if you remember, featured very high gas prices, not only for Southern California at SoCal Citygate, but also for the Southwest, as well as very tight supply conditions in ERCOT, MISO, and SPP. We see in our southern, southwestern areas a very high average price in February during this, based on that, these high prices during that week for Arizona Public Service, NV Energy, and the Salt River Project. But on average, prices were higher for CAISO. Here we're showing Pacific Gas and Electric DLAP, but in the gray dashed line, and the balancing area of Northern California in blue. The northwestern areas, including PAC West, Puget Sound Energy, Portland General Electric, and Seattle City Light, and PowerX, were generally lower in all months. Take a few slides to talk about EIM sufficiency tests. I'll note here that we published a special report on the changes the ISO is making. Changes the ISO, I think, made this week, as well as changes that were made back in February in Q1 of this year to these tests. That report is available on our website, and I am happy to take questions on that as well. But if you're interested, I'd suggest you read it. There are two types of tests performed as part of the resource sufficiency evaluation. One is the bid range capacity test, which we tend to call the capacity test, and the second is the flexible ramping sufficiency test. The consequences of failure are the same. Net imports if a test is failed in the upward direction, net imports into that area are capped based on advisory interval imports. Overall, the purpose of these tests is to ensure sufficient resources are scheduled and offered in the EIM to cover forecast load and ramping needs, plus uncertainty, and to deter excessive or intentional leaning. It was also viewed by Ferc as a mechanism to help deter the exercise of market power through physical withholding. The ISO identified two issues which were corrected on February 4th. One was the lack of exclusion of derated or capacity on outage from the bid range capacity test. And that actually affected a number of EIM areas. And the second issue which was corrected was that mirror resources were incorrectly included. And that change impacted the ISO, but not other areas. In addition, the ISO has proposed to add uncertainty to the bid range capacity test, essentially on the requirement side. I believe that change went into the market this week. Taking a look at the frequency of upward capacity tests by month, this metric is showing the percent of intervals in which there was a failure. It's a heat map, and you can see the highlighted square for February and Salt River Project. It's an area that would have been affected by the conditions in our market over that President's Day weekend. This is a very similar chart showing the frequency of upward sufficiency test failures by month. And again, Salt River Project in February failing in almost 10% of intervals in that month. We find that failures of these tests are highly correlated with price increases in these markets because they tend to be followed by power balance constraint violations. At the end of this quarter in March, the ISO implemented the first phase of Ferc Order 831 compliance, and in doing so, raised the penalty price associated with a power balance constraint violation from $1,000 to $2,000 per megawatt hour. These tests also exist in the downward direction. The consequence of failing in the downward direction is to lock exports. loss is not the right word, but to cap those exports at the advisory interval value. Excuse me. This chart is showing the frequency of those failures. And what we see is a higher rate of frequency, again, in the southwestern areas of the EIM. Excuse me 1 minute. These are areas where we see higher rates of solar penetration, and we tend to see these failures happening in the midday hours when that renewable generation is at its peak. One of the key benefits of the EIM for all of the areas is access to EIM transfers. The ability to transfer energy between areas is really one of the key benefits of the energy imbalance market. This chart is showing average 15-minute market limits between January 1st and March 24th. The reason we cut it off at March 24th is to keep the definitions consistent. After March 25th, bank is including areas other than SLED. So the chart is showing the average EIM transfer in the 15-minute market, the average limit from the area listed in the column on the left-hand side to the balancing area listed at the top of the screen. As you can see, there's a lot of transfer capacity available between the ISO and the Southwest, as well as between the Southwest and some of the eastern areas. There is less transfer capacity available between the northwestern portion of the EIM and the rest of the EIM area, and that shows itself in prices. This is another way of cutting the same price data that we've been looking at for the whole presentation. This is showing average 15-minute market prices for areas in the EIM, as well as for Pacific Gas and Electric, shown in the gray dashed line for the first quarter. As you can see here, the average 15-minute market prices for some areas of the EIM are following the net load curve in a sort of even more exaggerated pattern than the ISO prices themselves, particularly in the areas of the Southwest, NV Energy, APS, and the SRP. I will stop here for questions for just a second. All right. If there aren't any questions, I'll move on. Commitment costs and default energy bid enhancements phase 1 was implemented on February 16th. I think the ISO went to extraordinary efforts. This was earlier than this was originally intended to be implemented, and they went to extraordinary efforts to implement this in a timely way so that scheduling coordinators, market participants would be able to avail themselves of the new functionality that came with CCDEBI. What this initiative allows is for market participants to request adjustments to their marginal cost reference levels. Those are reference levels that are used in mitigation, as well as for bidding of commitment costs. In addition, CCDEBI allows market participants to make aftermarket requests for cost recovery to the ISO, particularly for costs that exceed the $1,000 bid cap, which was present at the time of implementation. There are two venues for making these requests. One is automated, and the second is manual. And there are definitely right times to use one rather than the other. Of the 20 manual reference level requests that were made during the week of higher gas prices, and there were 20, most were rejected, and that was due to a lack of documentation or because the requested fuel price was low enough to be submitted through the automated process. So really selecting the wrong venue. There was one automated request that was accepted, but that did not have a market impact because the resource was on outage. Ferc Order 831 compliance. I see a question from Callie Wells. Callie, if you could state your question, since I'm not able to read it in the second it flickers on the screen, I'd appreciate it.
I can read it to you. It says, of the manual requests that were rejected due to being low enough to go through the automated process, did you see those then submit automatic requests and they were just rejected? Do you need me to read that again?
No.
Okay.
I can take that question on follow-up. I do not believe that so this was implemented on February 16th, so it was implemented towards the middle end period of this high gas price period. I do not believe that the manual requests which were rejected were then resubmitted, but I need to check. So Callie, please, if you would like, please feel free to send an email and ask.
Okay, and there's also a question on the phone if you'd like.
I'd be happy to.
Oh, never mind. They took their hand down. It looks like they took their hand down. So.
Thanks. Probably Callie. Okay. All right. Ferc Order 831 in its first phase was implemented on March 20th. And in the first phase, what this did was allow some resources, some market participants, to bid between $1,000 and $2,000 per megawatt hour. Those participants included virtual as well as import. In addition, this raised the penalty price associated with the power balance constraint under supply violation from $1,000 to $2,000 per megawatt hour. From March 20th until earlier this week, we have seen PBC violations, power balance constraint violations with penalty prices up at the $2,000 per megawatt hour value across the EIM, and I would expect that we will see an increase in, sort of compared to a counterfactual. With $1,000, we'll see an increase in average prices due to that power balance constraint penalty price increase. Aftermarket cost recovery for costs above $1,000 was available with the implementation of CCW in February 16th. But Ferc Order 831 compliance relied on that, and then Phase 2 was implemented on June 13th. Effective June 13th, so I believe that was Sunday of 2021. And with that, while you're putting your questions in the queue, I will take your time to talk about something I care about, and I think you may not quite as much, which are settlement timeline changes. This is from a presentation the ISO made in training, which is available on the CAISO website and linked at the bottom of the screen. And what it shows on the top is the settlement timeline for 2020 and years prior compared to the settlement timeline for 2021 and going forward. DMM supported these changes, as did numerous market participants, and they were approved by Ferc. what has happened is that our initial settlement data is now available at T+9 business days, and our final settlement data is now available at T+70 business days rather than T+55. The difference here is that this is now about 14 weeks out from our trade date, and that we no longer have available in our internal databases interim settlement values. So for prior reports, we were able to estimate and rely on some of the interim data that was available prior to the last settlement statement. Due to systems changes that came with this settlement timeline change, we, for market monitoring, now can see the initial settlement data, and then we can see the final settlement data at T+70B, but we cannot see any of the interim data in between. And that is why we are not reporting several sections that we typically do in the report. I did want to reassure you that we will continue to monitor those. Should we see a dramatic increase or a noteworthy finding, we will report that publicly in as timely a way as we can. So, for instance, we are not reporting on offset costs. Those were quite high in Q1 on an estimated basis, and I will wait until they are final. But potentially report those in our Q2 report. Likewise, the wholesale energy cost is not included in this report. And with that, I've completed the presentation today, but I'm happy to take any questions at all.
As a reminder, ladies and gentlemen, if you'd like to ask a question over the phone, please press #2 on your telephone keypad. And there are currently no questions in queue.
All right. Thank you all very much for your time today. It's a very busy week for the ISO. I am counting, I think, about 5 things that have been implemented over the last week, in addition to the very tight system conditions and heat wave that is going across the WEC. I thank you all for your time and attention today. Please do send an email either to me or to the Department of Market Monitoring should you have any questions at all about the report. And I wish you a pleasant afternoon. Thanks for your time.
That concludes our conference. Thank you for using Event Services. You may now disconnect.